हेलो एंड वेलकम। आपका स्वागत है इस फाइनेंस शो में जिसका नाम है बैंकर से चर्चा विद आशीष कपूर। In this episode, we are going to chat all about the macros. It is my privilege today to host the remarkable and exceptional Shri Maneesh Dangi, who's been a trailblazer CIO at Aditya Birla Sun Life previously. He's a fixed income and portfolio management expert, guru of the macros, valuation and markets, and the founder of Macro Mosaic Investing and Research boutique firm. Welcome to the Banker Se Charcha podcast, Maneesh.
Thank you, Ashish. Pleasure to talk to you.
Great. So आज मैक्रोस की चर्चा करेंगे हम बैंकर से चर्चा पर, so obviously मजा आएगा. Manish, before we get into the world of macros and markets, I wanted to inquire about, you often describing yourself as a probabilist and cycle investor. So what exactly does this signify for the benefit of the uninitiated? And two, how important is it for the people to get a handle of some, basic macros during their regular investing or cycle investing journey across markets?
So, first the probabilist part. It's basically, it's a basic idea that the future is inherently uncertain, and its outcome could be different. And you potentially, with some prior knowledge, you could assign some probabilities to it. So, I kind of think of life as such as a cyclical phenomena. Good times we get bad times, and bad times we get good times. Same thing happens in industries. Some industries are sunrise industries, and eventually they become sunset ones. Destruction is the only method of renewable. In my worldview, and in that context, I see markets as well, right? It's little in our Indian spiritual tradition, it argues of it's basically a cyclical tradition that upar niche hota rehta hai har cheez, and you go through this cycle. So that's the basic understanding of how I see future. I do not see a future as predetermined. I do not see moves in a just one secular direction. And sort of, maybe take a pause and purely, instead of talking philosophy, talking of markets here, there are two points to keep in mind, as investors. One, success is rare, okay? Now, it's important to understand that, for every United States of America as markets, there is Japan, France, Italy, who sort of have delivered sort of zero returns in last 50, 60 years. Okay, for every India, there's a China, for last 20 years, zero returns. So for every one successful company, there are 5 companies which actually shut down. And we're talking of the top 2,000 firms in last 50 years. So basically, one, it's important to recognize that success itself is rare, okay? It's not, evolution does not predispose us to succeed, The method it employs for some to succeed is the destruction of most. That's one prior. And second is that there are regimes in markets, particularly, Ashish. In a sense, there are regimes, the countries which win wars, succeed. Like in World War II, US was the only winner and therefore succeeded massively. And all that who lost, failed miserably, So Portugal, if you had invested in World War II, before World War II or after World War II, to date, you've not made real returns, So that's the context that there is cyclicality. And there are regimes. There is an inflation cycle, deflation cycle. And we can talk of all the macros, But basic understanding I want people to understand is that, one, the success is rare. Two is that it depends upon the regimes that you are in, the context that you are in, the environment or the exteriors that you are in. And once you sort of know this, you begin to then think that, okay, let's not marry ourselves to any secular idea. And basically, it's a decent position to take that, okay, it's possible that things will trend, but let's not be too obsessive about it and be iterative in terms of thinking as to how things might evolve. So that's the sort of modamoti picture idea of probabilistic. And then that gives birth to the cyclical investing that, okay, let's invest in stuff which is at margin for the given exteriors and macro things are looking good, invest there. And if things are priced, risk is already overpriced or more than adequately priced, then, let's take a sort of withdraw from there and, take a good look at other things, what looks good or what does not. So that's the idea of cyclical investing, that, once you have sort of a reasonable surface area of, all sorts of assets, you could dabble in sometimes US equities, sometimes Indian equities, sometimes bonds, and so on and so forth. So that's the idea of cyclical investing.
Great. So there's been a lot of press as well, and deservedly so, on our favorable macros and growth potential, etc. What factors do you think are driving this upward trend in India and the optimism? And two, equally crucially, what curveballs does one need to be wary of? For instance, how is corporate profitability looking in the year ahead, and any challenges you foresee there or elsewhere?
So the evolution of India's macro has been from sort of very bad in 21, 22. So, I mean, a year ago rather,
Right.
to now relatively better, our CAD currency rates all sort of seem to be flashing reasonably green right now. So to that extent, it is okay to be excited about India's stability macro. But India's growth macro, actually, if you were to compare us today, in last 5 years, we've grown at about 4% CAGR, which is like 4% annual, which is pretty bad growth. We've done worse than China. Our gap between the US growth and India growth has actually worsened. So our growth macro, and unfortunately for a variety of reasons, because of lockdown in COVID, because of ILFS before that, and for so on and so forth, despite a very good macro, Ashish, I mean, our growth does not seem to be accelerating. So it's a mixed bag. So there is one, of course, narrative, that it's a great, setup, which is a little bit of a propaganda by elites. I talk of, Mumbai elites, which are market types and of Delhi. They all love to do this propaganda that India is shining, but it's not. It's okay, mediocre macro, a mediocre growth macro, so to say. So that's how I would sort of, take a view of local macro conditions. On profitability, I think you asked, right?
Right.
See, the basic questions I'll answer like this. Last 5 years, Indian corporate profits have CAGRed at 15%. Great. Okay. Last 10 years, they CAGRed at 10%. The big question markets are asking and should be asking themselves that, is it going to be 10 or 15? Because this 15 is part of that 10% growth in 10 years, right? Because last 5 years is 15%. Markets are pricing in about 14-15%, growth of earnings. But it's difficult, if the nominal GDP is going to be about 10%, which is 5% inflation, 5-6% growth, then unless there is a leverage cycle, kicking in, it's very unlikely that, your profits will grow faster than, nominal GDP. If your ROEs are 14% Indian corporate, and there is a retention ratio of 70%, then again, that gives you an insight as to difficult to have profits grow by more than 10-11%. So it's more likely that over next 10 years, Indian firms' profits will grow at 10% versus 15%. Again, last 5 years, the GDP grew at only 10%, nominal, I mean, okay? 10% every year, which is 4% real growth and 6% inflation. Whereas the profits have grown at 15%. Thanks to corporate tax cuts and, of course, the large, profitability increase pretty much across the world in last 2.5 years because of COVID and after COVID. So, these are the moving parts in assessing corporate profitability. I would bet that it's likely that next 10 years would be like last 10 years instead of last 5 years, which is more like 10% growth than 15. And if that is so, for these reasons that I mentioned, from ROE to nominal GDP growth, it is likely that markets are somewhat mispricing. Because, see, markets are trading at like 4.8 times, 4.7 times price to book Nifty. And so that's sort of expensive, and it's actually baking in, if you do ERP calculations, baking in more than 10% growth. So, that's the way. There's a glass half full. I think Indian profits wouldn't be very bad as they were during 2013-18, but would not likely be as good as 18-23. More of an average of 2013-23 is what you'll get in 2023-33.
Right. Right. So could you explain also, I wanted to check regarding the, your buy valuation sell macro framework, which if I've understood correctly, implies, being overweight on equities when valuations are inexpensive during times of easy monetary, fiscal and tax policies, and vice versa. If you could kindly elaborate more on this broad thumb rule.
Look, basically, I'll tell you, typical top-down macro allocation frameworks globally have been, various cousins of, Ray Dalio's original framework. I think he put out in 70s, which is the growth inflation quadrant. Okay, which is basically that the growth is accelerating and inflation is falling. Is great setup for equities, and if it is vice versa, then it's if the inflation is falling and growth is falling, then it's great setup for bonds. And then you figure out something else in the other two setups. So that's the quadrant that he put out. Most frameworks in the world, top-down frameworks are, as I said, close cousins of Ray Dalio's framework. Some of course improved upon it in last couple of years. They actually started to look at, instead of absolute growth numbers, the rate of change framework, which is if the growth is increasing from where they are, even though it's very low, it is good for equities. And if growth is decreasing from where we are, which is like, let's say we are growing at 9%, but if it is headed to 7, then it assumes that the markets are already baking in 9, and if it is going to be 7, and if you can have pinpoint at a deceleration of growth, then it's bad. So, okay, that's first, prior that the growth inflation framework is the basic prior for most macro traders. Okay, I have tried to sort of improve upon it. Instead of growth, even in last 10-12 years, especially after GFC, policy has become significantly bigger force in actually driving markets. So instead of growth and inflation, I have actually bundled them together through policy. That okay, if policy is tightening, it's bad for assets like equities, and if it is loosening, it's good for equities. So that's one dimension. And then I bring in another dimension which the growth inflation framework completely misses, which is a valuation framework. That can I have, through relative valuation, a state that today's valuation is actually more expensive or cheaper than historic versus, let's say, India's valuation versus S&P 500 and India's valuation versus India's own bonds. So in some sense, can you figure that, the valuation of the equity today is cheaper or more expensive relative to something else? Be it S&P 500, history of Nifty, or Indian government bond. Okay. So what I've done is that, and I think it's a bit novel, but who knows? I mean, actually anything you say has been said before. So, but I think what I've done is that, I pushed these two together and then built a new quadrant of valuation and policy. And thereby I get the 4 quadrants there. Okay, one is that, loose policy and cheap valuation hug equities. Basically, if valuations are expensive and macro is bad, go cash. And then, basically, I've put an algorithm out for my own investors and myself that, okay, how do I actually, you can't do 0-1, so you have to navigate through this process of actually whether policy is tightening at margin and how tight it is versus relative to the past and so on and so forth. And, I figure out the equity exposure. I figure out, let's say, US versus India exposure and so on and so forth. So that's the broad big picture, Ashish, my framework of valuation, buy valuation and sell macro.
Wonderful. In fact, I've read many of your blog posts also with great interest, like how you mentioned bonds work well during, when policies are tight, unlike equities, which perform better under loose policies. So I just wanted to, if you could kindly explain this, for the benefit of all, and how can investors understand or judge that? I think you were getting onto it. And you also mentioned the fact that, you've been doing research work or algorithms by a firm, which perhaps could, for instance, help professional managers, advisors, and others on this aspect. If you can kindly elaborate on that as well.
Okay, so first the question on, if the policy is, what's the basic understanding is that bond is an instrument that the policy makers use to actually force economy in a certain direction. Okay. that they wish it should be, but it is not at. Okay. And so therefore, if let's say financial conditions have tightened dramatically to the extent that business cycle is having a little bit of unwind, and that then policymakers would say, no, hey, let's loosen up the financial conditions. The instrument they use is bond, which is let policies come off, let's do QE, and let's stock up stuff in the market. Things are fine. There's no recession stuff, and so basically that's loosening conditions, which basically lower the bond yield, and in turn sends out a message to people at large, entrepreneurs and marketsmen together, alike rather, that look, it's a party time. Okay, so loosening financial conditions are expressed through lowering bond yields. Okay, so which is why, and vice versa, if you want to actually tighten sort of fist on the market and stuff, then you actually have to tighten. So when you are tightening, essentially you are taking bonds to a point where they do not deserve to be. But please understand, since it's a chimta, right? It's an instrument. And so to that extent, it has a job to do. But then we as investors can actually say, hey, if these guys are simply wanting to slow the economy by tightening financial conditions so much that the bonds are so much higher, I would rather participate in bond, because eventually that policy would work and things will have to loosen up. So when policies are very tight, like such as today, you would have read, I put out my blogs that, time is coming close to dial US treasuries, or maybe perhaps at some point in time in the next 6 months, Indian government bond, because rates are tight. Okay. And vice versa, when rates were too loose in 2021, between August 2021 until early 2022, it sort of made sense because rates were too loose that they will tighten, and therefore it made sense to unwind equity exposure and bond exposure both. So this is how it sort of operates.
Great. One final question before we let you go, Maneesh. I wanted to discuss a bit regarding the eternal, equity and debt debate. Broadly speaking, risk versus return quandary in the minds of investors. There was also an old adage which I remember that one of my bosses used to say: if you want to multiply your money, place it with an equity trader. But if you just want to protect and keep your money safe, give it to a bond dealer. Not sure how much of that is relevant today, but doesn't the comparison of returns across different equity and debt classes fluctuate basis the time periods of comparison also? And two, we've discussed a bit, but what is your take on current market valuations vis-a-vis earlier years or of developed markets, as well as your expectations going forward when the tightening eventually reverses?
So the current macro, I'll answer that first. Basically seems decent, as I said, in local macro. It's just that the US is at a recession cliff. I am off the team now because I've been sort of fully bullish on US. We dialed US equities in December, which again I put out publicly also that we actually undialed. We exited it last week, and so it's a cool 40-odd% return that we made. But point is that at margin, I think earlier they were people were too early in baking in recession, and I think recession is now, people are too confident that recession is not there. Okay, so we've swung from one extreme in 2022 to now another, and I think sort of odds are high that you would get this right if you bake in 6-8 months out a year recession, which in turn will pave way for earnings decline. And that in turn would mean, like S&P 500 right now, as I put out, that is pricing in $245, $250 of earnings, and at 4,500, $250 for 2024, and $250, I mean, and at 4,500 S&P 500, it's very, very expensive, almost 22, 23 times. And if there were to be recession, then it's likely that the earnings will decline by 20%. That's in average, and which means you will get about $200 earning, and an average valuation is 17 times. So you can calculate that markets have no space for any accident right now, and therefore while the macro is decent for India and US, but growth macro is worsening, and if there were to be recession, then I think markets are going to nosedive again. So to that extent, I'm actually we've undialed, like we've taken risk off US also. So that's how I think of valuation. Indian valuations are, right now we're pricing in about 1,000 rupees of earnings for Nifty, which is about 19.5 times forward earnings is what India is trading at. It is, of course, 10-12% expensive. But I think more importantly, India price to book is almost trading in top decile, So again, very little margin of safety available in Indian equities even today. I think short-term bonds sort of look decent, and eventually in next 3-4 months, I think there should be a place for long-term bonds to be dialed. So that's how I think of valuation.
Great. And for the risk versus return equity debt debate.
Yes. Sorry, I forgot. I mean, see, basically, I often argue that it makes sense to consider all of these assets as part of the same yield curve, and I mean, you can't be people like us, who have only one job to do, which is to sort of dial in, dial out various asset classes. I mean, people are running their shops and businesses, and of course, they can't do it. Right. All they can do is, that if things are too expensive, then avoid those at margin, be underweight and overweight something else which is not too expensive. So, which actually tallies well with anything which has a great narrative right now is likely to be very expensive in any case. Okay, so it makes sense to be at margin, be contra. But yeah, historically speaking, it is right that if you stay invested in equities for very long, it's likely to earn you 3-4% more returns than bonds. But then that 4% is not constant. If you invest in 1992 in India or 2007, you earn barely 1% more than bonds. But if you invest in 1998, 97, or you invest in 2003, or you invest in 2009, then you earn 8% over bonds. So, while the big picture thing is that, you could earn a 4% return, but that 4% can be for very long term just 1%, and could be very long term 8% depending upon the valuations that you dial it at. Okay, which is why the whole framework that can we either you do SIP, which is absolutely great. Okay, right, then I'm not going to bother about anything, and I'll just plain vanilla SIP, absolutely great product. And I think 99% of the people shouldn't bother about this conversation of ours. Simply invest in something which is keep investing in dollar cost averaging, But then people who want to do underweight, overweight, do not want to get carried away in the narrative, I think could use a framework that we discussed.
Right. Great. Thank you, Manish. It was wonderful as always hearing your views and the current state of markets. आपका बहुत-बहुत शुक्रिया. आज के लिए इतना ही दोस्तों. आशा करता हूं कि आपको ये चर्चा आज पसंद आई होगी. आप इस वीडियो को लाइक करें, शेयर करें और चैनल को सब्सक्राइब करें. अगले एपिसोड में फिर आपसे मुलाकात होगी एक नए चर्चे पर, एक नए विषय पर. धन्यवाद, शुक्रिया, आभार, थैंक यू. जय हिंद.